a lot of times in the investment world or any financial market, we look at contagion, meaning, one financial market ultimately, spilling off into another. And it's traditionally a negative impact, right? It's one we saw it in the financial crisis where one sector ultimately affected another. If we have that same mindset, what are some of the factors from other financial markets that are affecting real estate prices and the appreciation of real estate?
You start.
Well, contagion, from my perspective, has a negative connotation usually. I'm watching so closely the Evergrande debacle, and I think they're going to screw the pooch here very shortly after the recent need to take down 40 massive buildings. China controls almost 40% of the world's commodity prices, right? So you think about how that translates into iron ore, steel, even lumber, copper, PVC piping, all the things that Craig and I use to build out our structures. A lot of people are seeing inflation, and I think that will continue for some time. But if we watch the China and Evergrande debacle closely, if that comes crashing down, which I hopefully it does actually, I think we'll have positive contagion in the sense that we'll see cheaper commodities to our projects. Now, we got lucky. China didn't let our banks into that market very much. And so the exposure to the banks in our system is way smaller than it was back in '08. So that's the question, is how much of that collapse may trickle over to the U.S. economy? I'm not an economist that specializes in that, but from the outside, it seems like it's not going to be too much.
In my opinion, the biggest risk to the financial markets and real estate is the Fed and the federal government's fiscal position or lack thereof. The Fed has acted, in my opinion, in a very irresponsible manner. Yes, they irresponsible. Okay. They've saved us from COVID with some great actions in early 2020, but they should have curtailed those actions a lot sooner and a lot more aggressively. We looked into this M2 money supply, the supply of dollars out there in the market grew by 40% from 2010 to 2020, which is about 4% a year, 3.5% compound, which is a lot. And then since COVID has grown by another 40%. And 40% growth in M2 money supply from the Fed buying bonds with its accommodative policy, wiring money to Goldman Sachs and Citigroup and JP Morgan, dollars that didn't exist before they pressed the button and hit send. That's why we have 20% inflation right now. It's not 7%. Anyone with eyes can see that food is up 20, 25, cars are up 30, energy's up 50, housing is up 25, apartments are up 25. Where's 7? Nothing that I see is up 7. And it's the Fed. Meanwhile, the leaders in Washington, frankly, on both sides, but one side is worse than the other in terms of spending. They want to give away more money that doesn't exist, the federal government doesn't have, because they don't understand that eventually actions have consequences. And instead of fulfilling our obligations and promises to fund Social Security and shore up that money so it doesn't have to automatically cut payouts in 7 or 8 years, or shore up Medicare funds, the commitments that we've already made, they want to go out and make a whole bunch of new commitments that we can't afford. It's destroying the value of the dollar. And so I want to be in hard assets, in bricks and sticks type of assets as an inflation hedge. And because I hope the federal government can't come and take that asset from me. And so I think, instead of shoring up our financial house, we're continuing to head down the wrong path. And both political parties have responsibility here. So I'm sorry for the political rant, but
no, Craig, I think one tidbit from this for investors listening is that, again, hard assets. I mean, anyone who's owned assets through this period has done very well these last 18 months. Very well. I mean, even things like a Rolex watch has tripled in price, right? I mean, so if you own real estate and any sort of other assets, look at the used car market too, right? It's all gone up. And, so if you're in hard assets, fantastic. If you're sitting on dry powder or cash, that's probably the worst thing that you can be doing right now, letting your cash in the bank. So
that outstanding content. And I will tell you my benchmark for inflation, dog food. They just skimped my my 33 pound bag that I buy for my 2 boxer pups to 30 pounds 3 months ago. And then I just got a 10% hike. Ultimately, that's 20%. That is my benchmark for inflation here on out. If anybody wants to debate me on it, I'm happy to take them up on it. Outstanding content. Always love having you on, Tom, as my co-pilot. Greg, I'd love to have you back on here. Outstanding information. And I think you're going to have a lot of success in this 7 Square Properties. So with that, we'll see you guys next time.
Thank you.
Awesome.